Okay, so we discussed payout versus retention of cash in the last lecture. The main results are like this. First, if it's a perfect capital market, well, you might have guessed it. It does not matter whether the firm wants to retain the cash or it wants to return the cash to its shareholders. And then, if we're in a imperfect capital market with corporate taxes, then the result is like this. Corporate taxes make it costly for a firm to retain cash because firm has to pay corporate taxes on the investment returns from the retained cash. So the third part is about investor taxes, right? And then we said in the case of corporate taxes and investor taxes, that is, if we consider both taxes at the firm level and at the individual level, the result is still, generally, there should be some disadvantage if the firm retains cash. The equation is, if the firm retains cash, the firm's value of equity will be higher. So firm's share price will be higher. And this will generate some capital gain taxes on the individual level. Okay, so now let's today move on to the last section of this chapter, which is about stock dividend. Now, stock dividend, basically, just from the name, you can see that it is dividend in the form of stock, right? So basically, shareholders, they will receive some additional shares, and these shares are called stock dividends. Stock dividend also has a name, which is stock split. So these two names really indicate the same thing. Now, first, let's think what will happen if the firm issues some stock dividends to its shareholders. Well, first, the firm's market value of equity will not change. Why? Well, the reason is if the firm issues stock dividends to shareholders, then only number of shares will change, right? But you can see that it's just a numbers game. And this does not have real effect. More importantly, stock dividends are not taxed. So from both the firm's and the shareholders' perspectives, there's no real consequence if the firm issues stock dividend. Right? And you can see what will happen to the share price. Well, we know that if the firm issues stock dividends, investors will receive additional shares. Obviously, the number of shares would increase. And firm's market value of equity stays the same. So this basically means share price will decrease. So let's see this example here. Let's say the firm, Jinrong, paid a 50% stock dividend. So in this case, we say there is a 3-for-2 stock split. So why this is called 3-for-2? Well, the reason is if you have two shares, right? Let's say you're a shareholder, right? You now have two shares. And then after the stock split, you will get additional 50% shares. That is, you will get 2 plus 1, which is 3, right? Now, let's say there is a shareholder who has 100 shares before the dividend. And remember that we talk about this firm, right? So this firm has 100 million shares. I think its share price is $42. So if the shareholder has 100 shares, then the total portfolio value would be 42 times 100, which is 4,200. Now, after this stock split, you can see that 2 shares would become 3 shares. So you can see that 100 shares would become 100 times 3 divided by 2, which is 150, right? So 100 shares would become 150 shares. And because the portfolio is worth 4,200, we know that stock dividend does not change a firm's value. So the portfolio value, the portfolio value should stay the same. So it's 4,200. You can see now the share price would be 4,200 divided by the number of shares, right? 28. And you can also see this using this this balance sheet here, right? So let's say before stock dividend, right, the firm has 20 million cash and 400 million of other assets. So its total market value of equity would be $402.20 million, and the firm has 10 million shares, so its share price would be 42. And now the firm says, hey, I want to do a stock split. So 10 million shares would become 15 shares. In this case, you can see that all these values should stay the same. Share price would become 28. I mean, this is really easy to understand, right? Let's say if a firm does a stock dividend, let's say it's 2 for 1, which means 1 share would become 2 shares, right? And we know that the firm's market value of equity equals share price times number of shares, right? Number of shares. And now let's say this is before stock dividend. And now let's say the firm does a 2 for 1 stock split. In this case, you can see that we will have 2 times the original number of shares. Okay. Now, what is the share price after the stock dividend? Well, it's pretty easy to see that the share price should be the original share price divided by 2, right? Because in this case, you can see that these two numbers will just cancel out. So the market value of equity would just stay the same, right? So basically, you can see that if there is a 2 for 1 stock split, that is 1 share would become 2 shares, then the original share price would decrease by 50%. Right? Okay, now you might want to ask if theoretically stock dividend is just a number game, it does not change firm value, then why do firms actually want to do this kind of transaction, right? Well, the reason is because, think about this. If you do a 2 for 1 stock dividend, then your share price will actually decrease by 50%. That is, if the original share price was 1,000, after this 2 for 1 stock dividend, share price will become 500. And then you will have more shares in the market, right? So if your original number of shares was 1 million shares, after this this stock dividend, you will have 200 million shares. You can see that this has some benefit to retail investors, right? First, share price is lower, right? So now small investors can actually afford these shares, right? Second, there are more shares in the market, which means there is larger liquidity, right? So whenever there is increased liquidity, then transaction will become easier. So this will also be appealing to small shareholders. And research generally shows that if a firm announces there is a stock split, then on average, there will be a 2% stock price increase. And you can see that if you look at recent stock split, so let me find out my browser. Oops, where's my, okay, this one. So let's say, what are the famous stock? Oh, okay. I think Tesla did a stock split like 2 months ago. So let's see what Tesla has done. So you see that. So on August 31, 2020, Tesla did a 5-for-1 stock split, and you can see you can see why Tesla wanted to do this, because actually before this stock split, share price was about $2,200. And you can see that if you're a small investor, if you just have a very small investment account, you might not be able to afford one share, right? Because you need at least $2,200. And then after this 5-for-1 stock split, you can see that the share price would become 498. So you can see that now as a retail investor, you only need 500 to afford Tesla shares. Basically, you can imagine that there will be increased demand if price is lower, right? Because more people will be able to afford these expensive shares. So this will boost share price. Okay. Now, opposite to stock split, we also have reverse split. So in this case, a firm will use reverse split to reduce the number of shares. Remember that in the case of stock split, the firm increases the number of shares. So in the case of reverse split, obviously, a firm reduces the number of shares. So why a firm would want to do this? Well, the reason is the major motivation is because share price is too low. Let's say if a firm has a share price of 0.6, and this firm now engage in reverse split. So let's say it's 1-for-2, right? So this is 1-for-2. That is, 2 shares will be combined, will be converted into 1 share. In this case, you can see that stock price will increase from 0.6 to 1.2. That is 0.6 times 2, right? Because after this reverse split, 1 share represents the value of 2 old shares, right? So you should use 0.6 times 2 here. Now you can see that share price will actually get a boost from 0.6 to 1.2, right? So why do firm want to boost its share price, even this does not increase the firm's value? Well, there are several reasons. The first is exchanges. They have some lower bound on the share price. So if your share price drops below that lower bound, then you will be delisted. That is, you will get removed from the exchange. For example, Nasdaq has a $1 minimum price requirement. And then the second reason is some institutional investors, such as pension funds, mutual funds, they don't buy low price shares. And the third reason is very low stock price conveys negative information to investors. Because, well, think about this. If you're trying to buy a certain share, if you see its price is only 1.2, what's your guess? You will first think, well, maybe this share has 1.2, very low price. It's because its price has decreased a lot, right? So basically, it means that once an investor sees a very low price, investor will associate this low price with a bad firm, a bad investment. Okay, so you can see that a firm uses stock split and reverse split. The firm can actually keep share price in any range it wants, right? So for example, Citigroup split its stock 7 times between 1990 and 2000, and for a cumulative increase of 12-for-1. That is, after 7 times this transaction, the one share in 1990 will become 12 shares in 2000. And then in May 2011, it implemented a 1-to-10 reverse split. So in this case, 10 shares would be converted into 1 share. And this increases its price from 4.5 to 45. Okay. So this is a picture which shows you the range of different share prices in NYSE, right? So in this New York Stock Exchange. So you can see that most of these firms, they have share price between 2.5 and 65. Of course, there are a lot of outliers. If you look at tech firms, right, at least for the last 5 years, tech firms' share price was quite high, right? So I think Amazon has a price of 2,000 or 3,000, and Google has a price of 1,300 or 1,500. Okay, spin-offs. So spin-off is also a form of stock dividend. So basically, a firm can use spin-off to distribute shares of a subsidiary to its shareholders. So what happens is, let's say, okay, let me use this example here. So we have 2 examples here. So Motorola Solutions was pressured by Carl Icahn. This guy is a very famous activist investor. So this guy would this firm would spin off Motorola Mobility, and Motorola's shareholders would receive shares in the new firm, and then they could trade their Motorola Mobility shares as well as the shares of Motorola Solutions. Okay, let's see how this works. So basically, let's say there's a firm, okay, which is called, so this firm is called Motorola Solutions. And you're a shareholder, right? So let's say you're the shareholder. So let's say you have some shares of this Motorola Solution. And now, let's say the firm has a subsidiary, right? So this is a firm's subsidiary. right? And due to some reason, maybe because of activist investors' pressure, Motorola Solutions decides to spin off this portion, and it called this spun off portion as Motorola Mobility. Right? So now this portion will just disappear. Right? So we will have something like this. So this portion will become an independent firm, which is called Motorola Mobility. But you can see that this Motorola Mobility was actually part of the old original Motorola solution. So the new shares, the shares of this new firm should be distributed to the old shareholders. So after this spin-off transaction, this shareholder, the parent firm's shareholder, will receive additional shares from this new firm. So basically, the original shareholders or the parent firm shareholders now will have two firms' shares, right? So the old firm's shares and the new spun-off firm's shares. Okay, the second case, so Bell Canada Enterprises spun off 35% of Nortel in May 2000 through a stock dividend in which each BCE shareholders received 1.57 shares of Nortel. So in this case, basically, we have a firm which is called BCE, and then we have a shareholder which holds some shares of BCE. Now let's say BCE has made some investment in another firm. Let's say this is called Nortel, and let's say its investment is given by this portion. And now BCE tries to spin off its investment in Nortel, right? So this is like 35%. And how BCE can spin off its 35% Nortel shares? Well, it can just distribute these shares to its shareholders. And now the shareholders will get shares of BCE and shares of Nortel. Right? So in this case, you can see that its investment in Nortel will be returned to its shareholders, right, in the form of stock dividend. Now, so why do firms want to do these transactions? Why spin-off exists? Well, it's really because spin-off can separate or divide a firm's businesses into individual businesses. And this is good for several reasons. First, this will improve incentives to managers, because you can see that, let's say if you have a firm, right? Let's say it has some good business and it has some bad business. So maybe shareholders will want this firm to spin off this bad part, right? To just spin off this bad business. And then this firm's management can just focus on good business. And then there is also some corporate governance effect. That is, if you separate a good business from bad business, then it will become easier for shareholders to see the value of each individual business. And then it will be easier for shareholders to evaluate the performance of each individual managers. So this will basically provides better incentive effect. And then there's another reason, that is spin-offs. They can actually relieve investors of the worry that funds will be siphoned from one business to support some unprofitable investments in another business. So if you think about the merger between Tesla and SolarCity, so both firms had Elon Musk as their CEOs, and then Elon Musk merged these two firms. So Elon Musk merged these two firms into one firm, that is Tesla. And then investors wasn't happy. The reason is because SolarCity was always a money-losing business. So you can guess that possibly investors were thinking that, well, maybe Elon Musk would actually siphon some money from Tesla's car business into the SolarCity's solar panel business, right? So I remember that there was a lawsuit back then. So you can see that in this case, maybe to spin off SolarCity from Tesla would make shareholders happier, right? Okay, now there is another question, right? If you think about it, basically, what is a spin-off? It's essentially a parent firm returns its investment to its shareholders. But you can see that instead of using stock dividend, the parent firm can actually use cash dividend, right? For example, think about the BCE case, right? So BCE wanted to unload its investment in Nortel. What it did is it returned its shares in Nortel to BCE shareholders. But you can see that there is another way, right? BCE can actually sell its shares of Nortel. BCE will get some cash from selling its shares, and then it can return the cash to BCE shareholders. But why don't firms use this cash dividend? Well, the reason is because, first, if you want to sell your shares, it will be expensive, right? So you can see that in this case, BCE holds 35% of Nortel. That is large. That is a very large amount of equity. So if BCE tries to sell, it will be hard to sell because the value is just too large, right? So this will generate a very large transaction cost if BCE tried to sell. So you can see that using stock dividend can help avoid these high transaction costs from subsidiary sale. And then the second reason is stock dividend is not taxed, and cash dividend is always taxed. That is, if you return cash to your BCE shareholders, then this will always trigger a tax event. That is, once you receive your dividend, you have to pay tax every time. But if you receive shares, you will only pay tax when you sell those shares. So basically, you can see that if you use stock dividend, shareholders can defer taxes if they hold these shares, and if the shareholders they don't sell, they would never need to pay the tax, right? So you can see that stock dividend in the case of spin-off has some tax advantage. Okay, great. So we basically finally finished this chapter. You can see that chapter is really just about um, payout, right? That is how a firm can pay back its cash to its shareholders. Right? Okay, now let's see these review questions. First, what is the targeted repurchase? Um, so targeted repurchase means that if a firm tries to repurchase its shares, then it can approach a large investor. Presumably, this large investor holds a lot of shares. So this is a targeted repurchase because you essentially target one shareholder for your stock repurchase. How important is the firm's decision to pay dividends versus repurchase shares, assuming perfect capital markets? Um, well, it does not matter, right? Because we have perfect capital market. Of course, on a high level, you would say, according to MM theorem, these financial transactions does not change firm's value, so share price should stay the same, so it does not matter. And then through our examples, remember we talked about a firm which tried to pay back its cash to shareholders, and the firm can use several methods, right? So the first method was about just use dividend. Then the second method is about using repurchase. The third method is about the firm will actually issue some new equity and raise some additional cash and use this additional cash to pay an even higher dividend. And we did some calculation and we find out in the end, firm's share price would always be the same, no matter which method the firm chooses. Okay, the third, why would investors have a tax preference for share repurchase rather than dividends? What is the dividend puzzle? This one is actually pretty easy, right? Both capital gains and dividends are considered as equity income. And if the firm engages in share repurchase, then investors will realize capital gains. However, in most countries, according to their tax code, the tax rate on capital gains is generally lower than dividend. So, from a tax perspective, investors essentially will have higher after-tax income if the firm uses share repurchase to return its cash to shareholders. So that's why investors will have tax preference for share repurchase. So the dividend puzzle basically says that theoretically, shareholders prefer share repurchase to dividends. So a firm should never use dividend. But if you look at data, a lot of firms are paying dividend. So that's the dividend puzzle, right? Because we have the data, the empirical evidence, which is different from our theory. So that is considered a puzzle. Is there an advantage for a firm to retain its cash instead of paying it out to shareholders in perfect capital market? What if capital markets are not perfect? Again, we're dealing with the perfect capital market. In this case, you can see that it does not matter because, very importantly, in perfect capital market, we assume there are no corporate taxes and no individual taxes. So firm's value would be the same no matter whether the firm wants to retain the cash or pay the cash out to shareholders. What if capital markets are not perfect? Well, if capital markets are not perfect, very importantly, we will think about the result, the effect of corporate taxes, right? So, in the case if there is corporate taxes, then we would know that firm should not retain its cash, because if the firm retains its cash and make the investment, for example, if the firm uses its excess cash to invest in some fixed income product, then it will get some interest payment. In this case, you can see that in the case of corporate taxes, firms, they have to pay corporate taxes on those interest payments. And then we also consider a more complicated case. That is, there are investor taxes. Generally, there will be still some disadvantage of cash. If the firm tries to retain cash, the firm will actually generate some capital gains, because we talk about this. Retaining cash will increase the value of equity, which could generate some capital gains, and this will cause investors to pay additional capital gain tax. So generally, we still consider that there is tax disadvantage of cash. That is, cash, that is, retaining cash will actually reduce a firm's value compared with paying the cash out to shareholders. Okay, 6. What possible signals does a firm give when it cuts its dividend? Typically, if a firm tries to cut its dividend, it sends out a negative signal, right? Because it basically means the management conjectures they cannot sustain the current level of dividend. This conveys negative information to shareholders, because shareholders think, well, why the firm cannot sustain its current level of dividend? Why the firm has to cut the dividend? Well, maybe because in the future, the firm will have very bad project returns. Maybe in the future, the firm will suffer from a huge failure. Right? So this negative information will basically drive down the firm's share price. Of course, this could be a case by case. So this could be a case by case analysis. If you see a firm, and this firm says, "Hey, I'm gonna cut my dividend," but the reason that I want to cut my dividend is because now I have some great investment opportunities. So I will use my cash to invest these great projects. That's why I want to cut dividend. In this case, you could imagine that possibly the market will have positive response to this cutting dividend announcement. Why would a firm initiate a reverse stock split? The basic reason is because by using reverse stock split, the firm can reduce its number of shares. This means its share price will increase. Now, why firm wants to increase its share price? We basically talk about 3 reasons, right? The first reason is exchanges have listing requirement. So if your share price is too low, then you will get removed. Second, pension funds and some investment firms, they don't like firms with ultra low share price. Third, investors, when they see a very low share price, they will conjecture that the firm has suffered a lot in the past. That's why this firm's share price is so low. So this potentially means the firm is a bad firm, right? So low share price conveys very negative information. So firms want to avoid it. So they would be happy to increase its share price to show investor that, well, maybe I am not that bad. Right? Okay, great. So now let's move on to the next chapter. So next chapter would be about options. So options are more advanced content in corporate finance, and well, options are like everywhere, right? So if you take a investment course, then you will get to know options. If you take a course in derivatives, then you will know options. If you take a course in risk management, well, you will learn options. So you can see that this is so the chapter on options is actually pretty important, right? But here, when we talk about options, we will restrict ourselves into the content which focuses on how options theory is used in corporate finance. That is, we will try to use option to understand corporate finance applications. So our goal here is not about option investment. Our goal here is to use option theory to understand some corporate finance applications. Right? So it's still a corporate finance course, even we're learning about options. Okay, now let's first learn about some option basics. So option is fundamental a contract. So it is a contract. Now, what is this contract about? Well, if you're the owner of this option, you will have the right to purchase or sell an asset at a fixed price at some future date. So you can see that this definition here has several important elements. First, it is a contract. Second, if you're the buyer of the option, you have the right, right? And you will not, so you have the right, but it's not the obligation. And then you will make your transaction at a fixed price at some future date. The most common type of options is stock option. That is, option contract based on equity, based on stocks. Now, there are basically two kinds of options. The first is called call option. The second one is called put option. Call option gives its owner the right to buy. So it's the right to buy. And put option gives its owner the right to sell. So let's see some examples. So let's say you have bought a call option on Apple stock. Now, what does this mean? Well, it means that now you're the buyer, you're the holder of this call option. So let's say you will have the right, you will have the right to buy Apple stock for $75 at any time up to January 16, 2019. So let's say you have bought a put option, again, on Apple stock. So what does this mean? Well, this means that as the holder of this put option, you will have the right to sell Apple stock for $50 at any time up to January 17, 2018, right? Obviously, these numbers are just made up numbers. You could use any number, right? And any dates. Now, as the holder or the buyer of this option contract, if you want to enforce the agreement to buy and sell stocks at the agreed price, then we say you're exercising your option. In an option, we have exercise price. It is also called strike price. Strike price is the price at which the option holder buys or sells stocks when the option is exercised. And every option contract has an expiration date. It means it's the last date on which an option holder has the right to exercise the option. And there are two major kinds of option styles, depending on the dates on which the option can be exercised. The first or the most widely used options format is American option. It can be exercised at any time before or on the expiration date. And then a less widely used format is European option. It can only be exercised on the expiration date. So we have said option is fundamentally a contract. So when you're talking about a contract, you will generally have two parties, right? These two parties, they sign this contract. So this is the same case in the option. In an option contract, we will have an option buyer or option holder. So the option buyer will have the right to exercise the option. And we say that this option buyer has a long position in the contract. And then we also have the option seller. We also say this is the option writer. And the option seller has the obligation to fulfill the contract if the option buyer decides to exercise this contract. And we say this seller has a short position in the contract. So let me draw a picture to better illustrate these definitions. So let's say this is a option contract, right? So these two guys, they sign this option contract. And let's say this is a seller. So the seller sells the option contract to the buyer. And seller is also called writer. So you could say selling a contract or writing a contract. They're exactly the same. And buyer is also a holder. And when you sell or write a contract, you're taking a short position in the options contract. When you're buying an option, then you're taking a long position. And if you're taking a long position in the options contract, then you will have the right. Right? Basically, if you're having a call option, and if it's American style option, it means you have the right to purchase this asset before a certain date at a certain price. And then if you're the seller, you have the obligation. That is, if you have sold a call option, it basically means that if the option buyer decides to exercise the contract, then as a seller, you have to deliver, right? You have to sell the underlying asset to the buyer. Okay, we have defined a bunch of definitions, right? So these all kinds of definitions might seem confusing, but if you look at examples, you will find out it's pretty easy to understand option contracts. So let's say you hold a call option on Apple stock with the exercise price of 55. So you can see that here you're a buyer, right? And you take a long position. Let's say Apple's stock is trading at $75. Now you decide to exercise the option. Remember, you're the buyer, right? So you have the right to exercise the option. Now the option writer has the obligation to sell you the stock for $55, right? Because this is the exercise price. When you bought this call option with an exercise price of 55, it basically says that before the expiration date, you, the buyer of option, has the right to purchase Apple stock at the price of $55. And then the seller will basically have the obligation to sell the buyer the Apple stock for the exercise price of $55. So you can see that in this case, you will get a profit of 75 minus 55, right? Because this is the market price. And this is your exercise price. So you made the purchase at $55 when the market price is actually 75. So you get a net gain of $20. And you could also see what's the motivation of buying a call option. Well, it's because you expect the share price will increase, right? In this case, you can see that if Apple share price is higher, you will earn more, right? Let's say if it increases from 75 to 85, and you exercise your contract when the price is 85, then you will earn $30 per contract, right? Okay. From this example, you can see that you will earn money, right? You will earn $20, right? But why option sellers will want to sell you the call option? Because your gain comes from the option seller's loss, right? You can see this. You, the buyer, get 75 minus $55 profit. Right? But what about the seller? The seller sold you Apple stock at $55 while the market price is $75. So the seller has to suffer a loss of $20. So basically, in a call option, the buyer's gain is the seller's loss, right? But why sellers would want to do this? Well, it's because as the buyer, when you buy the call option, you have to pay a price to buy it, right? So the price of the option is called option premium. Essentially, when you buy the option, you pay option premium to the option sellers. So that's why option sellers would want to sell options, because they want to sell, well, because they want to earn option premiums. Okay. So stock options are traded in exchanges. So in the US, the largest option trading exchange is CBOE, so Chicago Board Options Exchange. In Canada, it's Montreal Exchange. By convention, the expiration date for stock option is the third Friday of the contract month. Let's say if you have a call option which expires in December 2020, then the exact expiration date would be the third Friday of December. And stock option contracts are rated on 100 shares. And option prices are quoted on a per share basis. So it basically says that, let's say if you're trying to buy a call, right, and you have found out the price of the contract is $1. What does this mean? It means that if you want to buy one contract, then you have to pay 1 times 100, right? Because this 100 because this $1 is quoted on a per share basis. So it's just for one share. However, one contract represents 100 shares. So you have to time $1 with 100 to get the actual price you have to pay. Okay, now let's learn about reading option quotes. So let's say there is a firm, what's the firm's name? Oh, Bow.com. I don't know whether this is a fictional or actual firm. So let's say we have, so you can see that you have a bunch of call options and put options. Okay, maybe let's first read these numbers. So what is the bid? What is the ask? What is this number? What is this number? Okay, great. So let's first look at bid. What is bid? So bid is the highest price buyers wanted to pay. Right. So essentially it means for Bow.com stock, the highest price buyers want to pay is $48.35. And what is ask price? Well, ask price is the lowest price sellers. Oh boy. Okay. The app. Oh, now it works great. So, sorry for that. So ask price is the lowest price so it's the lowest. Oh, this app is really bad. Okay, now it finally works. So ask price is the lowest price sellers wanted to sell. Right? So it means that for Bow.com stock, $14.37 is the lowest price sellers want to sell. Now, what is this number? The $48.35 is the last actual transaction price. So volume is number of shares which has been traded. Okay, now let's look at these calls. Let's look at the call here. So this call has a, let me make this larger. So this is year, right? It's 2014. Of course, this is month, December. And you can see that this is a monthly call option. So basically it means that its expiration date would be the third Friday of December. And then 45 is the exercise price. So it means if you purchase this call option, then you will have the right to buy this, what's the share price? Oh, you will buy this Bow.com share at $45. And then BQWLIE is just the symbol for this call option. And then last sale price is the last transaction price of this call option. PC means prior close. It means this $4 is actually last day's close price. 3.7 is the bid price. It means it's the highest price at which buyers are happy to buy. 3.9 means the lowest price at which sellers are willing to sell. Volume 0. It means that there was no transaction happening. open interest. Open interest means the number of contracts which are not exercised. Okay. Okay, good. Now, let's say you decide to purchase one December 47.5 call option. So let's look at this table and see which one we're looking at here. So it's this one, right? So you can see that if you buy this call, then you will have the right to buy 100 shares at the exercise price, which is $47.5 per share. And then you can see that if you want to buy this call as the buyer, right? Let's say you will pay the ask price. Now, let's say you just want to buy one contract. What is the total amount you have to pay? Remember that one contract represents 100 shares. And the $2 is just a per share price. So it means you will have to pay 2 times $100. Okay, now let's look at options payoff at expiration. So now let's say we are looking at a call option, and this call option has a strike price of 20. So this is the strike price. Now think about this. Let's say you're the buyer, right? You're the buyer of this call option. So you know that the strike price is 20. Let's say now the market price, let's say now the stock price is $10. Now think about this. Do you want to exercise your call option? You don't, right? Because if you exercise it, you will have the right to buy the stock at $20. But the market price is lower, right? This basically means that if stock price is smaller than strike price, you will not exercise your contract. This is equivalent to say the payoff from your contract is just 0, right? So you can see that the payoff here is 0, right? And you can see that for any price smaller than 20, you will not exercise, and the price is always 0. Now let's say if the market price on the expiration date is $30, do you want to exercise it? Well, you will want to exercise it because if you purchase from the market, you have to pay $30. If you exercise your call, you pay only $20, which means you will get a $10 payoff, right? So you can see that your payoff here is actually stock price minus strike price. Right? So if the stock price is 30, you will get a $10 payoff. So this is $10. And you can try other higher prices. At 40, you will have $20 profit. And you can further see that this line is a 45-degree line, right? Because you can see that this is 20 and this is also 20, right? So this is a 45-degree line. That is so basically, to summarize, right? So before strike price, your payoff is always 0. After strike price, then your payoff, or the curve, or the line for your curve, or your line for your payoff would be a upward sloping 45-degree line. Okay, let's summarize. You can see that there are basically two cases. So let's say we use letter S to represent stock price at expiration, and we use K to represent the strike price. And now we want to find out the payoff or the value of your call option. As I said, we have two cases, right? If market price is larger than the exercise price, you will want to exercise because you will get to buy your shares at at exercise price K. And then the market price is S, which is larger than your purchase price. So your profit or your payoff would be the market price minus exercise price. Now, what about the other case? Well, if the market price is smaller than the exercise price, it means you will not want to exercise your call. So the payoff from the call option is just 0, right? So you can see that that's why the payoff from your call option at expiration date is given by this. This max S minus K0 is equivalent to this part. You're not required to memorize this max kind of notation because it's actually more confusing. It's a more compact form. It looks nice, but it's actually more confusing if you're not familiar with this kind of notation. So for this course, it's fine as long as you can understand this component and you can safely ignore this component. Now, what about the put option? You can imagine that put option is sort of like the opposite side of this call option, right? Remember what is a put option? It gives you the right to sell at the exercise price. So let's say the exercise price is larger than the market price. If you're the holder of this put option, you will be happy to exercise your option because by exercising it, you will be able to sell your stock at the exercise price, which is higher than the market price. And you can see that your profit would be K exercise price minus market price. Now, what about the other case? Well, if exercise price is smaller than the market price, you will not want to exercise your put option because by exercising put option, you can only sell at the exercise price, which is smaller than the market price. And you're definitely better off by selling your share at this higher market price. So, because you won't want to exercise your put option, the payoff from your put option is just 0. Or you could say your put option will expire worthlessly, right? Okay, so that's basically how you calculate your payoffs from call options and put options on the expiration date. It's actually pretty simple. Okay, that's for today's class.